Valuations using Excel, Part 2, Lecture 18. Lecture Outline. Hello, welcome to Lecture 18 of Equity Master Secrets. In this lecture, we're going to continue our discussion on valuation. So this will actually be our last lecture on valuation. And we'll talk about how to value franchises. So we're going through the different categories of valuation methods that we learned earlier and applying them to various examples. So this time we'll talk about franchises. And the first company we'll look at is Tata Sponge Iron Limited. So we'll give a little overview of the company. Following that, we'll look at some of the financial highlights, so i.e. the summary of financial statements. And then we'll talk about how to value this company, how to value Tata Sponge. And then we'll value the company using the EPV, which is the earnings power value method. Once we've finished with Tata Sponge Iron Limited, we'll move on to Asian Paints Limited. We'll give an overview of the company. Then we'll go ahead and talk about its financial highlights. And then we'll talk about how to value Asian Paints. And finally, we'll value Asian Paints using the present value method. So these are the last two methods of valuations that we want to apply our examples to, the EPV method and the present value method, and we'll apply it to these two companies. Okay, let's get started. Valuing franchises. So in the previous lecture, we looked at how to value companies whose return on capital is lower than or equal to the cost of capital. And whenever we value a company, in that situation, we're primarily looking at asset-based valuation, right? So either liquidation value or replacement cost. So this time we're going to talk about different methods that we've already discussed earlier, but now we'll apply them to some examples. And we'll consider companies that earn higher than their cost of capital. Okay, so when a company earns more than a cost of capital, we typically need to use a different valuation method. And we're going to consider two types of companies. So the first is companies that have a moderate competitive advantage, but whose earnings are not likely to increase much in the future. So in this case, we would think of the current earnings as expected to remain more or less constant over a long period of time. Okay, and obviously earnings, may rise with inflation, but that's not necessarily what we're interested in. We're looking at earnings that are even constant in real terms, as opposed to earnings that are growing in real terms. So for this case study, we've chosen Tata Sponge Iron Limited. And the second type of company we'll consider are companies that have a durable economic moat and solid future earnings growth prospects. And for this study, we've chosen Asian Paints Limited. So both of these companies are earning more than their cost of capital, but Asian Paints Limited is one that has a stronger moat and stronger earnings growth prospects in the future. So we'll look at these two different companies, and we'll apply the two different methods of valuation to them, and see how it works. And as obviously through using an example, it'll help you to learn how to do it yourself for other companies that you're interested in valuing. And once again, we would like to remind you, as we did in the previous lecture, that this valuation exercise is purely from an academic point of view. What this means is that the purpose of these valuation exercises is for you to learn how to do valuation, as opposed to a recommendation. So please do not construe this as a recommendation that we're saying you should invest in these companies. We're simply going through this as an academic exercise with the main goal for you to learn how to value companies. Okay, so this lecture we're going to be doing a mix of PowerPoint and Excel. So we'll be talking about the companies on the PowerPoint slides, and when we actually look at the numbers, look at the financials, and look at the valuations, we'll be doing that in Excel. So we'll go back and forth between the two, and also the Excel sheets should be available for you to download, so you can look at it afterwards and see if it makes sense to you. So now we'll get started with Tata Sponge Iron Limited. Tata Sponge Iron Limited overview. So Tata Sponge Iron Limited, or TSIL, is India's leading sponge iron manufacturer with annual production capacity of 390,000 tons per annum. It also operates a 26 megawatt power generation capacity. The company was initially set up as a joint venture between Tata Steel and the Industrial Promotion and Investment Corporation of Orissa Limited. In 1991, it became an associate company of Tata Steel following its acquisition of the IPICOL stake. And Tata Steel currently owns a 51% stake in TSIL. Okay, so now we have a bit of an overview of the company. Right, so we have TSIL, they manufacture sponge iron. Okay, and we have some numbers about their annual production capacity and also their power generation capacity, and also a little bit about how they were set up. Right, so it's been set up as a joint venture. So Tata Steel has a majority stake in this company. So that's something that you could think about as being, you know, somewhat favorable, given, you know, Tata Steel has a good, strong reputation. So that's something that, you know, maybe would affect our valuation, and we'll talk about it a little bit later. And you know, it's kind of been going through, it's had acquisitions and of this IPICOL. So it's a company that's been around for a long time as well, and is fairly entrenched. And we'll talk a little bit about more later why it has an economic moat as a result. And the next thing we will do is turn our attention to the financial statements. So we'll now look at some of the financial highlights for Tata Sponge Iron Limited, and we'll look at these numbers and see how good a company they are in terms of their financial performance. Tata Sponge Iron Limited financial highlights. So here we have some of the financial highlights of Tata Sponge Iron Limited. So we have some financial statements over the last 6 years. So, and we've kind of highlighted in this red column here numbers that we think are quite important. So we'll go through those numbers. We're not going to go through every single line because that will take a while. But we'll go through the ones that we've kind of flagged as being important. And certainly, you know, as I said, you can download this Excel sheet and look at this in a little bit more detail. So the first line is important. It tells us the installed capacity. So this is tons, and we can see that over the last 6 years, it's been at 390,000 or 3.9 lakhs, constant for the last 6 years. So the company has, as we've highlighted here, they have not increased capacity since the fiscal year 2006. So this kind of maybe should indicate that, you know, maybe increasing capacity if this kind of in this type of business is not easy to do. Then we have the capacity utilization rate, which is essentially looking at how many tons they actually make and sell versus their capacity. And we can see here that they're kind of operating close to full capacity. So their average is 87.5%. And in the most recent fiscal year, they operated at 92% of their capacity. It was lower in 2012, but then again very high in 2011. So the first kind of important points we want to note are that the company has not increased their capacity in 6 years, and they're also operating at close to their full capacity. So then we have some numbers for net sales, and we can see that they are growing and then falling during, you know, when growth was during the slowdown a little bit, and then recovered in the most recent year. The next thing we want to look at is this percentage of net sales, which is basically the raw material cost, right? So G10 divided by G6, the raw material cost as a percentage of sales. Okay, and this is quite high. It's 64.1%. So that indicates that most of their most of their revenues, 64% of their revenues are going to pay their net material costs. And when we look at this as a percentage of total operating expenditure, right, so now we're looking at percentage of net sales, net raw material cost divided by line 19, which is total operating expenditure. This averages to about 83% over the 6 years, right? So that means 83% of their costs, their operating costs, are just raw materials. So that's pretty large. So as we've noted here, raw materials is the biggest cost component. Okay, let's move on down, and we have a few different cost lines here. And then we get to total operating expenditure, and then we have our operating profit, earnings before interest, taxes, depreciation, and amortization. So that's going to be net sales minus operating expenditure. And then the next important line is going to be the EBITDA margin, right, which is simply just the earnings, so the operating profit divided by net sales. All right, so what percentage of our operating of our net sales is operating profit. So this is averaged to about 23%, which is a good number. However, we do see a slowdown in the last couple of years. So 2008, 2009, we were around 30%. 2010, 2011 in the low 20s, and then in 2012-13 it's below 20, between 17.8 and 15.1. So a falling EBITDA margin, which is not necessarily a good sign. And then we have we essentially take away depreciation and take away and then we get earnings before interest and taxes. So the EBIT margin again is just going to be the earnings before interest taxes divided by the net sales. And this is averaged to about 20% over the last 6 years. And again, we see the similar pattern that it's started fairly high and then has been declining over time. Okay, and then we have additional items, which includes other income, and then interest expenses. Then we get profit before tax, then tax provision, the effective tax rate, which is just tax provision divided by profit before tax. Then we get profit after tax, and finally we get the profit after tax margin, which is another number that's important from a valuation perspective. So this is actually what the company has left over once they've paid all their expenses and all their taxes, and this is going to be as a percentage of net sales, right? So we're going to have this is B31, so profit after tax divided by B6, which is net sales, as you can see up here, net sales. And again, the pattern of profit after tax margin follows a fairly similar pattern when we're looking at the EBITDA margin. That is, we have higher numbers and kind of gradually falling. In fact, this has fallen every single year in the last 6 years and averaged at about 15.9%. So moving on, we then get the earnings per share, which is just going to be the profit after tax divided by the total shares. And then the dividend per share, which is essentially what the company has been paying as dividends. And one thing to notice here is that the company does have a fairly stable dividend history. So even though they have had falling margins, they still maintain a stable dividend. From an investor's perspective, that's important because it means that it helps you to forecast the future dividend. And maybe even if profits are a little bit variable, you might expect a much more stable dividend. And then let's move on to line 39, which is the shareholders' funds. So this is net worth, or the book value of the company, right? So essentially the assets minus the liabilities give us the book value. And this has been going up over time. You can see that it's 2,435 in the start of the sample, and then goes up to 6,395 by 2013. This then gives us the book value of the share, and then we have a whole lot of other lines here. So accumulated depreciation, net block, capital work in progress. So now we're kind of looking at more of the balance sheet items. So next we have capex, or the purchase of fixed assets, and here you can see that this is somewhat volatile. We have a very high number here, which is 2010, and then it's a lot lower in 2011, and relatively low in 2013. And then we have total current assets, which is going to be excluding current investments, current liabilities, net working capital, cash, current investments, and let's keep going down here. 55, we have the debt to equity ratio, and this is basically 0, which means the company is debt free. That's a good sign. It's something we've talked about before, and it means that the company is able to finance all of its operations through equity only, and also through retained earnings. And finally, we were looking at the return on equity and the return on capital, and these are strong numbers, right? We've got 23.4% and 29.4% for ROE and ROC. All of these numbers are declining over the period, right? So they're lower towards 2012, 2013. So here we've indicated that the strong return ratios indicate that the company does possess an economic moat. However, it must be noted that ROE has been falling continuously, right? So they've had falling ROE, but they do have an economic moat as evidenced by their above average ROE. Okay, so now let's go back in to the PowerPoint, and we'll go ahead and talk about how to value this company. How to value Tata Sponge Iron Limited. So now we've had a look at the financial statements. Let's think about what is the best method to value this company. So due to the highly polluting nature of the sponge iron industry, there are heavy restrictions on capacity additions. And one thing that we noted was that the company has not added any sponge iron capacity since the fiscal year 2006, right? And that's due in part to the fact that there are heavy restrictions on adding capacity, so it's quite costly to do so. The company has reached nearly full capacity utilization rate, right? So we looked at the capacity utilization rate, and this was above 90% in the most recent year. And what this tells us is that there are really no avenues for future growth, right? Because we don't expect them to be able to add any capacity, and they're already using most of their capacity. So we can sort of assume that the company's earnings will remain more or less at their current levels. Right, so this kind of indicates to us that we do not expect any strong earnings growth for this company. So the company's return on capital has been consistently above its cost of capital. Okay, so that does indicate an economic moat, right? And we've talked about the different valuation assumptions, right? And now we're looking at companies where the cost of capital, the return on capital is higher than the cost of capital. So that's a good sign. However, the return on equity, as we saw, even though it was fairly high, the average was high, it has been on a continuous decline over the last 6 years. So this means that TSIL has a moderate economic moat, okay? And the reasons for this is that the first is that they are the largest sponge iron player in India, so they're the largest company in this industry, and they enjoy the parentage of Tata Steel, right? So because they're 51% owned by Tata Steel, that helps them as well, given Tata Steel is also a successful company. It also has a robust balance sheet with zero debt and a huge cash balance. Okay, so these are some good points about the company, and also the not so good points, or I guess things to keep in aware of, is that the economic moat is quite moderate because ROE has been continuously declining. And then given the company's business fundamentals, we believe that the earnings power value method would be appropriate to value it, right? So essentially we've looked at what we think this company is about and what are the best assumptions from our different valuation methods that we can apply, and the earnings power value method is going to be the best one for this company. Valuing TSIL using the EPV method. So under the earnings power value method, we assume that the company's future earnings will be equal to the current adjusted earnings. So what are the adjusted earnings? We've gone through this before in previous lectures, so we'll just recap a little bit before we go ahead and do the valuation in Excel. So the adjusted earnings are the steady level of free cash flows that will continue into the indefinite future. We assume that there's going to be no capacity expansion, right? Because we talked about it's difficult to expand in this industry, and the company's capacity utilization has been the same for a number of years. So we'll only take into account a maintenance capex, or maintenance capital expenditure. So some small capex that the company has to keep using in order to maintain its current level of operations, right? So keeping the plant running and so forth. So after estimating the adjusted earnings, we determine the cost of capital R. We will generally assume around 15% as a ballpark figure for the cost of capital. But this could vary depending on the riskiness of the investment. So typically, the more risky the investment is, the higher we would want the cost of capital to be, right? Because you would want a higher return for undertaking a riskier investment. And obviously lower risk, we may have a lower cost of capital. And the last thing we need to do is apply the earnings power value formula. So let's take a look at what this is. So the earnings power value formula is fairly straightforward. It's just the adjusted earnings times 1 over the cost of capital, or equivalently the adjusted earnings divided by the cost of capital. And this valuation formula is essentially the primary assumptions made are that there is no growth in earnings over time. Okay, so we don't need to take into account our expected growth rate of earnings. That's the first thing. And the second thing is that we expect that the current earnings, or the current adjusted earnings, will continue indefinitely into the future. right? So we're not expecting any increase in earnings. And this we kind of justify this assumption because we've seen that the capacity, they're already near full capacity, and we don't expect them to add any capacity in the future. Right? So that's kind of the main justification for using the EPV method. And then, as you can see, it's a fairly straightforward formula in order to calculate the valuation. Valuing TSIL using the EPV method. So we're not done yet. Once we have calculated the earnings power value, the next step is to find out the market value of the company. Right, so now we need to think about how do we translate this value into what the value per share would be, right? The intrinsic value of the company on a per share basis, which is ultimately going to decide whether we should invest in this company or not. So what we need to do is deduct debt and add cash to the EPV. So the reason we deduct debt is because we want to strip away the value of the company that belongs to the debt holders, and also want to add back the cash that the company has, because that adds to the company's value. So the market value is going to be the earnings power value less any debt plus all its cash and cash equivalents. Once we find out the market value, right? So this is the market value essentially represents the value of the company's equity, right? The market value of the company's equity. And we take this market value and we divide it by the total number of outstanding equity shares. Okay, so typically companies have a large amount of shares available that are traded on the market, and then or also issued to others that are being held. And then we take the market value and divide it by the number of shares, and we get the value per share, or the per value share of the company. Lastly, what we want to do is assign a margin of safety discount to the share value, given that the company is, for two reasons. One, the company is a small cap, and there is high sector specific risk. Okay, so the margin of safety is something that we always apply because, whenever we do these valuations, we do have a fair number of assumptions built into them, and there's always a probability that your valuation is not going to be exactly what the true value might end up being. So we want to allow some margin of safety just in case we're wrong. So typically that will reduce our valuation, right, the margin of safety. And one specific reason to apply it in this case is because the company is a small cap, there's high sector specific risk. So both of these things would mean we want to add a margin of safety discount. Alright, so now that we have all these tools, let us now determine the intrinsic value of TSIL using Excel. So let's go into Excel and we'll look at how to determine the value of this company. Tata Sponge Iron Limited valuations. Okay, so now we're in the second tab of the Excel sheet, and this is the tab on valuations. So the numbers that we need in order to first thing we're doing is calculating adjusted earnings. Okay. So we start with the earnings before interest and taxes, right, which is taken from the financial highlights B23. So that's on the previous tab that we looked at, and we've done this for each of the last 6 years. Then we take the tax rate. Okay. So the tax rate is assuming the effective tax rate for domestic companies in India, and this is just at about 34%. So one other note on the earnings before interest and taxes. Since we want to determine the distributable cash flows, we start the adjustments from EBIT, and that we've only taken into account core business earnings and excluded other income. Right, so there's some items on the income statement called other income, and we've excluded those. Okay, so we just have the earnings before interest and taxes, then the tax rate. Then we have the EBIT after tax, right? So then we're just taking the earnings before interest and taxes, multiplying it by 1 minus the tax rate to see what we have left. Then we add back depreciation, and then we subtract maintenance capital expenditure. So we've added back depreciation because it is a non-cash expense. And earlier we adjust the EBIT for tax since it is a real outflow of cash. So remember, we're looking at free cash flow here, right? So that's why we're adding back depreciation. And then we've assumed the maintenance capital expenditure to be the same as depreciation. Hence, adjusted earnings is the same as earnings before interest and taxes after tax. So what we're saying, our implicit assumption here is that whatever depreciation the company has, it has to spend that amount in order to maintain its operations. So really, we kind of cancel these two effects, cancel one another out. And then we get adjusted earnings, which is simply the EBIT after tax, and then taking into account depreciation and maintenance capex, which are a wash anyway. So it's just the same thing as earnings EBIT after tax. And what we can see here is that barring 2009 and 2011, the company's earnings have been at a steady level, right? So we've got all within the range of 600, so between 600 and 700, bar of these 2 years. Okay. So now let's look at, well, how do we actually value this? So the first thing we do is take the adjusted earnings. So here what we're doing is we're taking the average of the 4 years of earnings, where they're all in the 600 to 700 range, right? So we've taken the earnings for 2008, 2010, 2012, and 2013, and that becomes our adjusted earnings. Our cost of capital, as we mentioned, is 15%. And then the earnings power value is simply the adjusted earnings divided by the cost of capital, and this is 4,434. So keep in mind that this is in millions of rupees, of course. And then what we need to do is we need to subtract debt, and we need to add back the cash and cash equivalents. So the company's debt is at 0, which we mentioned earlier, and the company's cash is 3,613, and this gives us a market value of 8,047. Okay, so that's just going to be the earnings power value, subtract total debt, which is 0, then add back total cash. So it's basically the sum of these two numbers, and then we end up with the market value, which is 8,047. So now we are fairly close to being able to come up with the intrinsic value of the company. So the number of shares outstanding is 15.4, and again this is millions, so 15.4 million shares the company has issued, and then we get the per value share, right? So that's just going to be the market value divided by the number of shares. So this is kind of our estimate of what the per value share of the company is, based on the earnings power value method. We're not done yet because we still want the margin of safety, but before we do that, hopefully you should now understand how we get to what do we think the company is worth per share based on its market value, and then you can calculate the market value divided by the number of shares. And then we apply a margin of safety discount, which is about 20%. Okay, and in this case we've kind of said, well, because this is a risky small cap, there's high sector specific risk, and ROE has been falling over time, right? And then so for that reason we'd want to apply a margin of safety discount of about 20%, which is quite large. It means that we're valuing the company 20% less than the number we just get by using the EPV method. So once we take into account the margin of safety discount, we essentially take their value multiplied by 1 minus the margin of safety discount, so it's 80% of this original value. We get the per share intrinsic value after the discount. Right, so this is effectively what what we will say is the value of the company once we've taken into account the margin of safety. And one thing that's worth noting is that it's almost equal to the book value of the firm. Okay, so this kind of tells us that once we take into account the margin of safety discount, it's effectively as if the company's earning is equal to its cost of capital. Then we also get the implied price to earnings ratio multiple, which is 7.5, and we've taken this based on the 2013 earnings per share. The current share price, this is as of 27 January 2014, is 373, and then the difference between the intrinsic value and the share price, right, which is looking at our estimate of the intrinsic value, and the share price is 12%, right? So the company is trading at below what we think the intrinsic value of the company is. Okay, so this is how we do the valuation. So hopefully this makes sense to you, and I encourage you, of course, to download this and go through it and make sure you understand it well. Asian Paints Limited overview. So now we've got to the second part of the lecture. We'll move on to the next company that we're going to value, and this is Asian Paints Limited. So let's talk a little bit about the company itself. So Asian Paints Limited is a leading decorative paint company with a market share of over 50%. They have a presence in all 4 categories on the decorative side, and this includes interior wall finishes, exterior wall finishes, enamels, and wood finishes. APL has 25 paint manufacturing capacities and a 35,000 odd dealer network operating on pan-India basis. And it has high pricing power due to its leadership position in the decorative segment. So the first big statistic to note here is the large market share, right? So over 50% market share. That clearly tells you that it's definitely the biggest company. And even if there were, and assuming there are at least more than a couple of companies in this industry, it's probably the biggest by a fairly large margin, right? So as a result, it has high pricing power due to its leadership in the decorative segment. And they also have a strong presence, right, in all the different categories. And in addition to that, also paint manufacturing capacities and a large dealer network. They have a strong international presence across regions like South Asia, Middle East, and the Caribbean. So again, this company is also a multinational. So clearly, it's leveraged its advantage and also expanded its markets. So definitely things that we would consider to be good signs. Okay, so that's an overview of what the company looks like. And the next thing we'll do is we'll go into Excel and look at some of the financial highlights for the company. Asian Paints financial highlights. So now here we are back in Excel, and we're going to take a look at some of the financial highlights for Asian Paint Limited. So we've done a similar exercise to what we did with TSIL. So let's kind of look at some of the key lines and see what we think stands out here. So the first thing to look at is net sales, and also net sales growth the year below that. And what you can see is that net sales sort of increases at a fairly swift pace. So year-on-year sales growth is very good: 24%, 22%, 15%, 25%, 14%. So we've noted strong top-line growth of 20%. So that's good. Then we have increase or decrease in stock. Then raw materials consumed. Net raw material cost, which is simply the sum of those two numbers, and we have raw materials cost as a percentage of net sales. So here we can see is that raw materials make up around half of total net sales on average. So this is quite large, right? It means that half the company's revenues essentially go towards paying raw material costs. And then if we look at raw materials as a percentage of total expenditure, we get some pretty high numbers. So this is 69%, then 59, 57, 59, 61, 60. So they average to around 61%. And what this tells us is that raw materials are definitely the biggest cost component for this company, right? So they represent about 60% of the company's cost is just raw materials. And then we'll have a bunch of other costs that we've listed, so power and fuel, employee cost, other manufacturing expenses, selling and administration expenses, selling and distribution expenses, miscellaneous expenses, and then we get total operating expenditure, okay, which is the sum of all of these things. And then this gives us our EBITDA, or our operating profit. So this is going to simply be the net sales divided by the operating expenditure, and we can see that this is as a number that's also been growing over time. Okay, and if we look at the EBITDA margin, right, which is simply the EBITDA divided by net sales, right, so the percentage of net sales that is their operating profit, and this is kind of fairly stable over time, a little bit of fluctuations, but within a fairly narrow range. And is averaged around close to 16%. So the stable margin profile indicates pricing power, right? It means that their margins are not being eroded away by companies coming in and pricing cheaper. So this is a good sign for this company. Then we'll look at then we have depreciation, then earnings before interest and tax, which is just EBITDA minus depreciation. And then we have the EBIT margin, which is the EBIT divided by the net sales. And this number also follows a sort of similar pattern to the EBITDA margin, and is also quite stable, right? So it's just between 14 and 15%, and has been fairly stable over the last 6 years. So this itself should also indicate pricing power, just like with the EBITDA margin. Let's keep going down. Then we have other lines, so other income, then we have EBIT including other income, interest expense, then we get profit before tax, and then a small exceptional items. Then we get our provision for tax, then our effective tax rate, then we also have a small minority interest, and finally we get the profit after tax, which is taking into account all of these items, so profit before tax, taking away exceptional items, the provision for tax, and the minority interest, and we get the profit after tax here. And then the profit after tax is a percentage of sales, gives us our profit after tax margin. And this number is also quite stable over time. It's actually grown. It's from the first 2 years of this sample. And it's sort of stable at around 10%, and the average is about 10.1%. So that's a good sign. Next we have adjusted earnings per share and dividends per share. And adjusted earnings per share have grown quite rapidly, right? So they've sort of gone up by about 2.5 times in the last 6 years. That's quite significant. And the dividend per share has also grown very strongly as well, sort of in line with the adjusted earnings per share. And what we noted here is that we have fairly strong earnings and dividend growth of around 22%, right? So that's very good. That means earnings and dividends are growing at around 22% a year. And this is kind of in line with our top line growth of 20%, right? So sales are also growing by about the same number that earnings and dividends are growing. A little bit slower, but still both very, very similar to one another. So let's move on. Then we have the number of equity shares, the face value of the shares, the total share capital, total reserves, and then we have the shareholders' funds. Right, so this is kind of the equity value of the company, or the book value of the company. And this is the net worth, right, or the book value. This then gives us the book value per share. Next we have the total debt, we have the gross block, we have accumulated depreciation, the net block, capital work in progress, net fixed assets, capital expenditure as a purchase of fixed assets, and this is again from the cash flow statement. And then we have total current assets, which are excluding current investments. Then we get total liabilities, then net working capital, then we have cash in bank, current investments, cash and cash equivalents, and cash and cash equivalents per share. Then we have the company's debt to equity ratio. This is fairly low, so this has been 0.1 for the last 4 years. So this indicates that the company is nearly debt free. And finally, we have return on equity and return on capital. And these are some very impressive numbers. If we look at return on equity, it's averaged at around 38.5% over the last 6 years. That's very strong. And it has been relatively stable, a little bit of a downward trend, but still very high. And the same thing for return on capital. This has also been extremely strong, averaging at 46.6%. So these very high return ratios for the company indicate a wide economic moat, right? This means the company has a very strong economic moat due to these very high ratios. Okay, so let's now go back into PowerPoint and talk about how to value Asian Paints. How to value Asian Paints. So let's now think about, based on what we've seen in the financial highlights, what is the best way to value this company? So the first thing to note is that Asian Paints enjoys a strong leadership position in the paint industry. It has over 50% market share. Its nearest competitor, Kansai Nerolac, is just about 1/4 of its size. So we kind of inferred earlier that given its large market share, it's also going to be the largest company by a fairly wide margin, and this turns out to be the case. And as we saw in the company's financial highlights, Asian Paints has an impressive track record of high growth in sales, stable profit margins, high returns on capital, and a significant cash surplus. So we saw a lot of good things from that balance sheet, right? So sales growth, very high margins, which are stable, and very high returns on capital and equity, which are also stable. So the company's average ROE return on equity and ROIC, return on invested capital, of 38.5% and 51.8% respectively over the last 6 years. These are substantially higher than the cost of capital. Okay, so if you remember, earlier we used a cost of capital of 15%, and if we applied that here, it would be significantly higher. The ROE and the ROIC are much higher. And this indicates a wide and durable economic moat. So this is a company with a very, very large economic moat, and it certainly appears to be durable based on its performance over the last 6 years. So given the company's solid business fundamentals and future growth visibility, we believe that the present value method, which is used to value franchise with growth, would be most appropriate. And this is the valuation method that gives you the highest value for a company, right? Because it's kind of taking into account that we have an economic moat, and also taking into account that we expect earnings to grow considerably over time, right? So we would value this. So the method we use is the franchise with growth method, and that would be the appropriate one. Valuing Asian Paints using PV method. So now we want to think about, well, how would we value Asian Paints, since we've now decided that the present value method is the most appropriate for this company. So under the PV method, what we do is that we assume that the company's latest year adjusted earnings are expected to grow consistently at a certain rate G until perpetuity. So that means we assume that the country will grow at a fixed rate G into the indefinite future. To grow at this rate, we assume that the company will make reinvestments from its earnings at the same rate as G, while at the same time maintaining a steady rate of return on invested capital. Right? So we're going to assume that the rate on invested capital stays the same into the indefinite future. And at the same time, we also need to assume that the company's reinvestments that it makes will also grow at the rate G. And this makes sense. If their earnings are going to be growing by a certain amount every year, we expect that they continually need to make additional investments, because that way the return on invested capital stays the same, right? So if earnings were growing but investments were not changing, that would mean ROIC would have to go up, which is not sustainable in the long run. So we'll assume that ROIC stays the same, so both investment and earnings grow at the rate G. The next thing we need to do is figure out the cost of capital, or the discount rate. So in this case, given Asian Paint's strong fundamentals and low risk profile, we'll assume a lower cost of capital of 13%. Okay, so the cost of capital, as you know, must reflect the risk of the company and the fundamentals of the company. So in this case, as compared with the earlier company we looked at, in this case we have a lower cost of capital because the fundamentals are stronger and the risk profile is less for this company. Once we've estimated adjusted earnings, we plug our assumptions in the present value formula. The present value formula is the PV equals C times ROIC minus C times G divided by R minus G. So C in this case is the company's capital base, right? So that's the capital that the company starts with, and we take the return on that invested capital times the capital base. And then we subtract C times G, so that's essentially what the company is investing as well, right? Because their investments are going to grow at the rate G. And then we divide it by the discount rate, which we adjust for the growth, so it's going to be R minus the total growth. Okay, so this is the present value formula, and this is what we will use to value Asian Paints. Valuing Asian Paints using PV method. So once we've calculated the present value, the next step is to find out the market value of the company. And the market value of the company is going to reflect what we actually think the stock is worth. So this is going to be a similar way we did it with the first example, where we took the earnings power value, and all we do is we just take the present value, we subtract out any debt, and we add cash back to it. So why do we do it like this? Well, if we think of the present value as the value of the entire company based on its earnings, we know that a company has to is financed by both debt and equity, so the return to debt holders, or the value of the debt, must be subtracted off to find out the value of the equity. And then we also need to add back cash, because the present value is simply based on its earnings, doesn't take into account the cash balances. So that's why we deduct it, and we add back cash to get the estimated PV, to get the market value. So we have the market value is equal to the PV minus debt plus cash and cash equivalents. And the next thing we need to do is once we have the market value, and the market value is now the value of the company's equity, okay, or the value of all the shares of the company. The next thing we want to do is find the value per individual share, per each share. So we would take this market value and divide it by the total number of outstanding equity shares. Then this will give us the per share intrinsic value of the company, right? And this is actually the number that we think that this company is worth, or what we think is the intrinsic value of this company. So the next thing we're going to do is we're going to go back into Excel and continue looking at the Asian Paint spreadsheet. This time we'll look at how to value it, and we'll see that it kind of follows a similar pattern to what we did with the first company. So let's go ahead and do that now. Asian Paint's valuation using PV method. So now what we are going to do is we are going to show you how to value Asian Paints, and we'll use the PV method. So our first step is to estimate the adjusted earnings. Okay, so we start by taking earnings before interest and taxes, and you can see these numbers are just from the financial highlights page we looked at earlier. And so since we want to determine the company's distributable cash flows, we start the adjustments from earnings before interest and taxes level. So we should also note that we're only taking into account core business earnings, and we have excluded other income. Okay, so this is the core business earnings. Next we apply the tax rate, and we're assuming the effective tax rate for domestic companies in India. This is the same we used previously. Then we'll get the EBIT after tax, right? So this is just going to be the EBIT times 1 minus the tax rate, and then we calculate for each of the years. We adjust EBIT for tax since it is a real outflow of cash. Next, we add back depreciation, okay, and this is again taken from the financial highlights. We add back depreciation because it is a non-cash expense, right? So we're looking at trying to get the free cash flow, right? So we want to add back depreciation, and then we subtract out maintenance capital expenditure, and we've set this equal to depreciation. So we did this last time as well, right, with Tata Sponge, and essentially what this means is that we're assuming that the amount of money the company has to spend on maintenance to maintain its capital expenditure is equal to its depreciation. So this just cancels out for each of the years, right? So really we're still this EBIT number here then is essentially the same as just this adjusted earnings number becomes the same as this EBIT after tax, right? Because we just have these two cancel out. So then we get the adjusted earnings, which is the sum of the three above, but these two are 0, so this is just equal to the EBIT after tax in this situation. And so since the company is in the growth stage, we take the latest financial year adjusted earnings for our present value calculation. So we're going to be using this number here as our adjusted earnings. Next we have invested capital. Okay, and this is again taken from the financial highlights page. Then we have the return on invested capital, which is essentially the adjusted earnings divided by the invested capital. All right, so this is the ROIC. So invested capital, as you can see, is net fixed assets plus net working capital minus cash plus 2% of net sales, and then we can then use that to calculate the return on invested capital. And you can see here with the ROICs of over 50%, the company earns significantly higher than its cost of capital. So its ROIC is quite high, right? So it's on averaging above 50% or around 50%, and this indicates it's earning well above its cost of capital. Okay, so now that we have the adjusted earnings and we have the ROIC and we also have the capital, our next step is to actually calculate the intrinsic value. So we start with the adjusted earnings, which we've taken from this cell here, adjusted earnings for 2013. And as we've written here, since the company is in the growth stage, we take the latest financial year adjusted earnings for our present value calculation. The next number we have is the cost of capital. And since the company has a low risk profile, we assume a relatively lower cost of capital. And as we mentioned earlier, we'll use a cost of capital of 13%. Our next step is to calculate the growth rate. And essentially, we're saying that the growth rate is going to be 0.75 times the cost of capital. And we've estimated that at 10%. And also, we have to keep in mind that we cannot have long-term growth exceed the cost of capital. That's not necessarily sustainable. That you then, in the denominator where you have r minus g, you need to have r bigger than g in order for the solution to give you a positive number, right? So it must be the case that r is bigger than g, and we're going to impose that here by just saying that g is equal to 75% times the cost of capital. Okay, so we get a growth rate of 10%. Then we get the return on invested capital, and this we have as 39%. So the company has reported an average ROIC of 51.8% over the last 6 years. From fiscal year 13 until perpetuity, so into the indefinite future, we assume ROIC to be 3 times R, which is relatively more sustainable, right? So we've just taken 3 times the cost of capital to be the return on invested capital. And this is kind of close to the fiscal year 2013 ROIC. We know that these earlier numbers may not be sustainable over the long run, so we want something that appears to be more sustainable. Next we have the capital base, which is simply what we calculated up here, the invested capital. And then we get the present value, right? So this is going to be the capital base times ROIC. Okay, so capital base is here, ROIC is here. Minus C times G, so minus the capital base, C times the growth rate, 10%, divided by R minus G, so divided by the cost of capital minus the growth rate. And so that gives us the present value. Once we have the present value, we have to subtract away total debt, which is 3085. Then we add back cash and bank and current investments, which is worth 8825. And then this together gives us the market value of the company. Okay? So again, pretty straightforward how we go from the present value to the market value. Then the number of shares is going to be the total outstanding shares. So then we can then calculate the per share intrinsic value. So this is just the market value divided by the number of shares. And really what this number is saying is that for a company with strong fundamentals and a wide economic moat, this would be a fair price to buy that stock. Then we can get the earnings per share, which is from the financial statements, and the implied price to earnings ratio multiple. And now let's compare our intrinsic value share to the current price per share. So the current price per share is, as of 27 January 2014, is 476. So this is a lot bigger than the intrinsic value, right? So the difference between the two is 44%, where the intrinsic value is 44% less than the current share price. So in this case, we can see that according to our estimates of the intrinsic value, the company is overvalued, right, by a fairly large margin. And what's interesting is, even though we assume fairly, a relatively good growth for this company, so we're assuming that a company grows at 10%. We assume a fairly low cost of capital. So you would think that this would give us a high valuation, but it still actually doesn't come close to what the current market price is, right? So our estimate is clearly that the current price of this company is a lot higher than its intrinsic value, and we would conclude that Asian Paints is overvalued. Okay, so now we'll go back into the PowerPoint and we'll conclude. Conclusion. So this brings us to the conclusion of this lecture. So let's quickly recap what we've done in this lecture. So the first thing we did was we carried out a valuation exercise for 2 companies, right? So we looked at 2 different types of companies, one which had a moderate economic moat and no future growth, and the other with a wide economic moat and strong growth prospects. And both methods are variation of the DCF method, right? DCF stands for discounted cash flow. With DCF, we essentially forecast the company's future cash flows and discount it back to the present to figure out the company's value. But the EPV and the PV, the main difference between them and DCF is that we use current earnings instead of trying to forecast future earnings, right? So we just assume, in the case of the EPV method, that the current earnings will continue at the same level into the future. With the PV method, we assume that earnings will grow at a constant rate G into the future. So it must be remembered that valuation is a mix of both art and science, and intrinsic value estimates can vary from investor to investor. And what you'll often find is that people do disagree on what the valuation of a company is, right? There's no standard fixed way that's completely objective that's going to say that this is the value of the company, right? And that's ultimately because a company's future cash flows are in fact uncertain, right? So when we're, for example, deciding between the EPV method and the PV method, we're kind of doing what we think is most reasonable for that company. But of course, we may turn out to be wrong, right? So we may use the EPV method, assuming that earnings will stay the same, but actually earnings may end up growing quite rapidly over many years. We may use the PV method, but our growth rate assumption could be different to what actually occurred, right? So the point is that there's always a possibility you can make mistakes, and there's always some judgment that you have to use in order to determine the right growth rates, the right discount rates, and this will vary between different investors. Right, so intrinsic value estimates do vary from investor to investor, and that's fine. It's good to have a diversity of opinion typically, and sometimes you can use that to actually help your own valuation. Maybe you thought you missed something, or you can see how someone else would do it as well. So what are the key things we need in order to determine the intrinsic value? Really the most important is that we need a solid understanding of the company's fundamentals, okay? We need to know about its competitive advantage, and we need to know about its future growth prospects. Alright, so these three concepts are all linked, and if we can understand these really well, then this will allow us to determine, what is the right valuation method to use for this company. And if we know the right valuation method, then, we're more likely to come up with an intrinsic value that comes out correct, right? We'll get a better estimate of the intrinsic value. So with this lecture, we conclude the module on valuation methods. So now you've seen all the different valuation methods that we use here at Equity Master, and you can certainly put all the companies that you could analyze into one of these types of methods. The next module is on stock screeners, and here what we are going to do is look at a variety of different parameters that investors can use to pick stocks. Okay, so thank you very much for listening, and we'll see you next time.